Today is Wednesday, April 6th. Today I want to take a look at the ratio between the consumer discretionary sector and the consumer staples sectors. Supposedly you get a read on how investors feel about the economy and the market in general. So in the XLY in this case is the ETF for the consumer discretionary group. When this is beating the consumer staples ETF, in other words when the ratio is rising, you get an idea that people are feeling pretty good about the economy and the market. Unfortunately, it's not a perfect indicator. It really doesn't show everything quite right. Here in the leading up to the top in 2000, this ratio was falling, and you wouldn't expect that unless you're using that as an indicator for what might happen. I'm not so sure you can use it that far in advance, but again, for the most part, during the bull market, rising, flat heading into the financial crisis, then falling during that bear market, and then of course rising since 2009. Actually, let's take a look at the correlation between this ratio and the stock market using the compare feature here on Technician. I'm going to put the SPY ETF in here. I'm going to use a 50-day correlation, check that on, and add. You can see that the ratio rises and falls generally with the market, but it's not perfect. Down here in the correlation, most of the time, you see that it is positively correlated, but there are these big dips where anything goes. All right, let's just get rid of that for now. Just want to show that there's merit in using it, but it's certainly not a reason on its own to buy or sell. What we have here is a set of trend lines in the weekly format. You can see over here on this one, it hits the low there and the low here, so that's a pretty good line. This one hits one low, and this one hits one low as well. But together they form a set of fan lines, and it's kind of a gradual rolling over in the market. And when the third fan line breaks, then you have your sell signal. Former resistance now acting as resistance again. It was support, now acting as resistance, and then just more resistance above. So there's a lot of problems above for the ratio to get through. Now let's move into the daily time frame. Trend lines are still there. Alright, but what I'm going to do now is kind of get rid of some of these things just to declutter the screen. You can see RSI here, and actually I should have shown in the weekly chart this was showing falling highs, so that's a negative overall for the ratio. Alright, here we go. There are your trend lines. And now I'm going to do another line. I am just going to eyeball this, and that's not scientific by any means, and see what we have here. Get rid of this clutter. Alright, what does this show us? Well, in this short-term view it doesn't show us much. We can see a rally and a dip and a rally, a big rally and a big dip. So is this a left shoulder, a complex left shoulder, the head, and this possibly being a right shoulder? Well, let's find out. Go back out to the weekly. Looks a little more like it, but not exactly. So let's speculate a little bit. What would happen if the market did this and then did this to complete the head and shoulders pattern? Well, that would be a pretty clear signal that the ratio has topped, and if the ratio has topped, perhaps the market has topped as well. Or even if we get rid of that, and let's say it just goes down from here, well, that would show us pretty abstract head and shoulders, but sometimes when the right shoulder fails to form properly, we know it's really weak. But again, this is the ratio, this is not the market. What it's telling us is that the profile of the market is not quite what we'd expect it to be in a bull market. It's more of a bear market profile. That doesn't mean stocks are going down, but this is just something on the side of the bears. Something should be watched, but again, it's not a trading signal on its own.